Good afternoon. We're here with Yaacov Heidingsfeld, CEO of TraderTools, an instrumental industry participant, and you specifically have been around for a lot of time. I could say industry legend.
A legend in my own mind.
Stalwart. What would be the right adjective?
Old.
Old. Okay. Old but gold.
Old.
Okay. So as we were just starting talking before we got rolling, you were just off a panel about liquidity, swimming naked, as it were, and you were just telling me that the first question was about good liquidity and bad liquidity, but you think that the focus is elsewhere.
I think that, let's say, acquiring liquidity, getting into a relationship with a liquidity provider, that's the easier part of the strategy. And the common answers to what defines a good liquidity provider are things like fill rate and latency, and those are the typical topics that you'll hear when we talk about liquidity. But really, the problem starts elsewhere. And the topic, the name of the session was swimming naked, based on the Warren Buffett quote.
Yes, mea culpa.
No. I don't think that everybody got the reference.
Got it.
But when the water goes out, you see who's swimming naked.
Exactly.
Or when the tide goes out, I think is the correct quote. But that's really what I was talking about, in that the problem starts from the type of flow you're passing on to the liquidity provider. So all the brokers in the industry will get customers coming to them and telling them, my flow is soft flow, it's easy to handle, I want tight spreads, give me the best you've got. The broker in turn goes to the source of liquidity, the liquidity provider, and he says, I've got a new client coming on board, flow is amazing. And the liquidity provider will give him a good stream, a good spread, and a week later he's going to get a phone call from the liquidity provider. You ran me over. What kind of craziness is this? You told me it's soft flow. In most cases, the broker doesn't even know that he was lied to by the customer.
But that could be by a single trader? I mean, how granular is this process?
So the process can and should be down to the trader, the time of day that they're trading, the currency pair that they're trading at the time of day that they're trading. I heard from one of my colleagues yesterday that people are talking about the fact, and it came up again in today's session, the facts are that gold goes up in Asia and comes down in London and New York. And we see at some of our customers, you've got clients coming into the market with 10 lots of 10 gold to execute at the Asian opening, when maybe there's 5 lots of liquidity available.
So what do you do in this case?
So what happens is you have a major price move.
Right.
Until the liquidity replenishes. The machines are making the liquidity get more and more expensive until it replenishes. And then as the day goes on, the prices come back to a natural equilibrium. We see that all the time with the fix. We try and put through large orders at the fix. Now they expanded the fix to 30 minutes. Again, but if you take the time, and with the tools now available to the market, with large language models, we can call it AI if we want to get into the buzzword of it, okay? Where you can feed the historical data in, train the model with real-time information as well. You can see the trading patterns. You can see customers trading different customers trading similar instruments at repeated times of the day. You can identify when something is unusual. You can get real-time dashboards showing you this information. And we created a product called Price On, which ATFX has adopted. And by categorizing the customers into 2 general categories, and let's call them at the moment lucky and smart,
It goes deeper than that, right? You have something like 7, you told me.
6.
6,
right?
okay.
So in each category of lucky and smart, you have level 1, 2, and 3.
Wow.
Okay? And so by having this kind of a model and a dashboard, you can adjust your pricing to the type of customer that you're quoting.
Yes, incredible.
You can,
based on his past activity.
Based on his past activity and predicting what the future activity will be.
Right.
Okay? So there's a difference between back testing a model and a predictive model.
But when they've just joined, they're just in the system, you know nothing about them yet?
You know nothing about them yet, but it doesn't take a lot of new trades for you to start to say, oh, okay, so the first trade, you don't know anything.
Still lucky.
Still lucky, or
arguably.
Probably what you would do is put him on your worst feed.
Okay.
Okay? Your feed where you expect him to be the most difficult kind of customer to price.
Yes.
Okay? As the model starts to see how he trades, and again, with relatively few instances of trades, he starts to say, oh, this looks like a customer in this other category. He's trading the same instrument, he's trading at the same times of day, the length of time that he holds the position is similar. So I'm going to categorize him now as a lucky level 2 customer.
That's incredible, because I was doing this conversation with Hugh Wayland from the Singapore Stock Exchange, and I was struck to hear that he sees an activity supposedly by a single trader, if it's a rogue trader or just too lucky or too smart. And so I was struck to see that the exchange level feels, and he told me, oh yeah, we feel it and it hurts. So
well, if he's telling you that he feels it and it hurts, it's an important customer.
By all means.
Okay.
Okay, so it's not every Joe high churn coming from a sports sponsorship deal that the client did, and so on.
No.
Okay.
Okay, because otherwise he'd get rejected.
Okay, I see.
But obviously every single customer has a unique tag, and with the computing power that we now have and the tools that are now available in the industry, the ability to categorize those traders, put them into different categories in real time, you can, again, not only identify the customer, but the pair and the time of day and the length of time that they hold their trades.
So you foresee liquidity will be less of a relationship-based
I still
business?
I think it will be the relationships will be even more important. Because if I'm a large liquidity provider, if I'm an alternative liquidity provider like a Citadel or an XTX or a GTS, okay, or I'm a large bank like a JP Morgan or a Citibank or whoever.
Yes.
What I'm going to do when I look at you, my customer, is I'm going to say, how profitable is my relationship with you?
Okay, so I need to be in good terms with you to keep things going, even when
I have a very sharp customer that's very difficult to price.
I see. So the relationship as a hedging tool, The relationship
becomes even more important, because right now what happens is, and you see this in the industry, that people move from organization to organization.
Right.
And really when you move from one organization to another, what you take with you are your relationships.
Right.
So you've moved to a new organization, you call up the people that you used to do business with, and you say, I want to do business with you. And they say, well, the last liquidity manager at broker XYZ, it was a terrible relationship.
I see.
Okay? And you say, well, I'm here now, I'm going to protect you. I'm not that guy who doesn't care about you, I'm going to protect you. But again, you're relying on tools that are very retrospective.
Right.
Okay.
Yeah.
In terms of you get your markouts and your TCA a week in arrears, a month in arrears. The damage has already been done. So what you really need is something that's giving you that dashboard in real time.
I see. I heard the announcements, which means we are drawing to a close. Unfortunately, I could do this forever, but maybe to finish off, you've been around a lot of time. What piece of advice would you give to a broker who's just starting out?
Manage your relationships carefully. both downstream to your customers and upstream to your liquidity providers. Use tools available, my tool, any tool, to really get to know the flow that your customers are giving you so that you can accurately represent that flow to the sources of liquidity to protect those relationships.
So it's not only don't swim naked, but also don't swim blind, as you said previously.
Don't stream blind, don't stream naked, and remember, everybody lies.
Everybody lies and everybody hurts. Thank you very much.
It's a pleasure.